Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Hi everyone, welcome to Top Stock Picks of the Week. I'm Neena Mishra. I'll share my top stock pick and I'll then be joined by Andrew Rocco, who will share his pick, which is a very interesting one. My pick is a rather boring company. It is Caterpillar, which is the largest global construction and mining equipment manufacturer. So why I like this stock particularly now is because we are still in early days of trillions of dollars of spending from the Infrastructure Act and the Inflation Reduction Act. And Caterpillar is going to be one of the biggest beneficiaries of that spending. Now, let me share my screen and go to Zacks.com, and I wanted to show you some charts. So Caterpillar, ticker symbol CAT, is a Zacks rank number 1, strong buy stock, and the industry rank is also in the top 2%, construction and mining, because we have seen a surge in construction activity in the US. We have seen so many projects for electric vehicles, warehouses, new homes, etc., because I mentioned that spending from those two bills. And because of that surge in activity, the company reported excellent results recently last month. So if you look at the earnings surprise history, you see the big positive surprise, 23% there. And in fact, it beat both on the top and bottom lines and also provided an upbeat guidance. Now, it's construction products. The demand for those construction product has been rising despite rising prices because of rise in materials, inflation that we have seen, because the demand is so high. So Caterpillar is able to pass those price hikes to their customers. Now, after those impressive results, analysts have been raising their estimates. So you will see that estimates have been rising for the company. And that is the main reason why the stock went to number 1 rank, strong buy rank. Now, if you look at the longer term price consensus and EPS price chart, you will see that the company hasn't missed in the past few years, about 3-4 years. It has missed only once. Now, another reason why I like Caterpillar is because it is a dividend aristocrat stock. So you will see that nice dividend yield over there, and it is included in the S&P 500 dividend aristocrat index because it has been raising its dividend for 29 consecutive years, and it has paid a quarterly dividend since 1933. So these dividend aristocrats are stable, cash-rich companies, strong companies, and these usually do quite well over the longer term. I will now hand it over to Andrew, whose pick is a very exciting, very interesting stock, Carvana. Now, I have not been following the stock very closely, though a lot happening in that space, and Andrew will guide you through those recent what's going on with the stock. But I have used Carvana. I used it to purchase my car during the pandemic, and it was a seamless, hassle-free, great experience, and I will not hesitate to use them again to buy or sell my car. Andrew, I hand it over to you.
Thank you very much, Neena. My name's Andrew Rocco. I'm a stock strategist here with Zacks Investment Research. I'm also the manager of the Technology Innovators Portfolio Service here at Zacks. And my top stock for September 18th is Carvana. So let's jump into things here. So Carvana is an American online automotive retailer that specializes in selling used cars through its e-commerce platform. The company's primary aim is to simplify and modernize the car buying process by offering a convenient and largely online experience. So With Carvana, unlike a typical used car dealer, you can do all of your transactions online. You can sell your car online, you could trade it in, buy it online. And what's nice about Carvana is they made the purchasing process really easy. So they'll come to your house, they'll bring your car, or they'll pick up your car. They'll pre-approve financing over the web. So really you can do everything from the comfort of your own home. So it's really disrupting the way that people are buying and selling used cars. Another thing about Carvana is it offers a limited return policy. So if you don't like it after 7 days, obviously you've done everything online, you can return it within 7 days. So for those people who don't want to go to a dealership, it's really a nice alternative. I personally sold my car there. I got a very good price, and the transaction was quick and easy. So I would definitely use it again from my personal experience. But let's talk about the company's near bankruptcy in 2022. So it was definitely a milestone year for the company in the negative sense of the term. Their revenues remained strong, but Carvana mismanaged the way it was going to scale and expand, and its costs soared and debt really, really got out of control, basically. So the company had a lot of trouble scaling, and many investors were concerned about the long-term financial health. The stock went from over 350 a share, basically into the single digits. However, one reason I like the company is its debt. Although the debt still remains a large concern, Carvana will be able to reduce its total debt by over $1.2 billion due to a recent debt restructuring deal. So that means they're going to be able to lower near-term interest expenses, and it's going to provide a significant amount of flexibility for the company's profitability and growth plan. In other words, one of the main bear cases and one of the reasons people thought it was going to go into bankruptcy, that's kind of in the back burner now. Yes, debt is still a concern, but this restructuring is going to give Carvana a lot of breathing room and allow them to turn around the business. So while Carvana is still rebuilding, simply surviving from this stage could result in a considerable reversion to the mean type trade, in my opinion. And not only is Carvana restructuring its debt, it's really giving consumers a way to move away from traditional dealers and drive growth. Its integrated e-commerce platform encompasses every aspect of used car retailing. Its end-to-end compelling business model has disrupted traditional used car sales by allowing consumers to shop from the comfort of their home. So really, the sales and revenues were never a large issue for the company. You can see that the shares and the sales and revenue went from the bottom left of the chart to the top right of the chart. So they just needed to control their expenses and control their expansionary periods. And I think they're going to be able to take advantage of this rapid growth. Now let's move to a large news item. If you've been following the news, you probably saw the largest auto strike in history is currently going on. The UAW, or United Auto Workers, a prominent labor union in the United States, which represents workers in the automotive and related industries, is a lot of their members are going on strike. The UAW was founded in 1935, and it's one of the largest labor unions in the country. It has nearly 1 million members. 146,000 UAW union members went on strike from the big three. And the big three is Stellantis, which owns Chrysler, Ford, and GM. So with 146,000 auto workers on strike, at the big three, what that's going to mean and how that's going to affect Carvana is a lot less cars are going to be put into production, and thus the demand for used cars is going to rise dramatically. And this could be a windfall opportunity for Carvana. In fact, Carvana in a recent analyst meeting spoke about how it could definitely be an opportunity. They've only been on strike since Friday, but it's something to watch. Even if it lasts a couple weeks, it could definitely turn out to be a large catalyst for Carvana shares. Now let's move on to the technicals. You're looking at a weekly chart of Carvana here. The red line is the 10-week moving average. And the 10-week moving average is a key intermediate zone where institutions tend to step in and buy the dip on strong trending stocks. So you could see Carvana had that massive move higher, pulls in a uniform manner to that 10-week moving average. And unsurprisingly, it finds support, and now it's threatening a breakout. And if it does break out, in my opinion, the measured move is to around 70 a share over the coming months and even into triple digit territory by next year. And I just wanted to give you another view. On the daily chart, the stock is setting up in an inverse head and shoulders pattern. So really strong on both the daily and the weekly. We do want to see it get over the 58 level if possible, and that will lead to much higher prices. Now, Carvana, few investors probably think of Carvana as your traditional value stock. However, from a price to sales perspective, it is getting attractive here. The price to sales ratio is hovering near 5-year lows. Couple that with the debt restructuring and the turn in earnings, and it could be a recipe for higher prices. And what could add fuel to the fire, and what's been adding fuel to the fire this whole way up, is the massive short interest and stubborn short sellers. So right now, the short interest on Carvana is about 45% of the shares. 45% of the float is short, which means about 34 million is still short the stock even after the 1,000% year-to-date move. And just to compare that to the S&P 500, S&P is only up 17% year-to-date. So what happens with these shorts is the stubborn shorts need to buy back their borrowed stock despite the mounting losses because they get margin called, and that ends up pushing the stock even higher. So if it breaks out, a lot of those shorts will certainly be forced to cover. And here is a chart of the stock coupled with the earnings. So you can see the earnings are definitely starting to turn around, and the consensus estimates from Zacks suggest that they're going to move even higher over the next few years into 2026. Last quarter, Carvana incurred a loss of 55 cents per share in the second quarter, significantly lower than the 235 incurred in the year-ago quarter. So the loss came in much narrower than the Zacks consensus estimates of a loss of 113 per share. And Carvana's cost-cutting efforts are paying off. They completed the $1.1 billion of analyzed SG&A expense reductions in the second quarter of 2022. And in the last reported quarter, the company managed to achieve its goal of generating positive adjusted EBITDA. So definitely moving in the right direction. And once again, I want to underscore that it's not so much what the company is doing right now, because the company still has a lot of debt. But just a few months ago, investors expected this company to go bankrupt. Now they have a lot of breathing room. They turned around estimates, and it's definitely on the right track. So this is a reversion to the mean trade. Even though the stock's up so much year to date, you have to take it in the context of the overall move. And there's definitely still a lot of room to go. So the bottom line is Carvana is transforming from dying to thriving. Debt is shrinking. Revenues are increasing, and the stock is retreating to an attractive entry zone. So let's look for the stock to first trend towards 60, break out of that base structure that I talked about, and hopefully we'll see some higher prices into year end. Full disclosure, I do own Carvana in my personal portfolio, and we hold a position in the Zacks Tech Innovators portfolio as well. Thank you all so much